My name is Keith Collins, and it's been my great pleasure to work in agricultural policy for 40 years. Farm policy is all about ensuring the capacity to produce an adequate and nutritious and healthful and importantly affordable supply of food for American consumers. That's what farm policy is about. Farm policy, when I first started working in agricultural policy in the mid-1970s, was a set of programs run by the government that controlled the amount of acreage a farmer could plant, that set minimum prices for crops in the marketplace through something called the non-recourse loan program, and then paid farmers whenever market prices were below a government set price level, an administered price called the target price. So it was a package of supply control, minimum price, and direct payment programs. Together, those were called income and price support programs. They were designed by the government, the farmer was the recipient, and simply had to do what the government said the farmer had to do. So it wasn't very market oriented. These programs distorted farmers' choice of what crops they could grow. The prices in the marketplace were sometimes not in touch with the market. And that started to be realized over time. And so in 1996, we eliminated acreage control programs. So farm programs became much more market oriented over time. And they became smaller because of budget constraints. At the same time, we had disaster policy, which was fashioned around passing legislation after each disaster, called ad hoc disaster assistance legislation. That became very costly, wasn't very well run, wasn't very equitable to farmers who suffered losses, and it begged out for a substitute. And that substitute became the crop insurance program. That's what Congress wanted, that's what Congress funded, and that's what has prevailed, because today the crop insurance program has become the centerpiece of the farm safety net. Now the way that happened was it started with the government running crop insurance from 1938 to 1980. It was a completely government-run program, sold by the government, serviced by the government, and nobody participated. The record of sales was poor. The government did not do a good job in running that program. So in 1980, the Federal Crop Insurance Act created a public-private partnership where the government would regulate and fund a program, provide support to producers to buy policies, but the policies would be sold and serviced by private companies. And that started the remarkable chain of events that brought us from about 50 million insured acres in 1981 to 294 million insured acres today. Private people were given an incentive to sell policies. They got a share of the premium that had to be paid on the policy. Well, guess what? When you provide the private sector an incentive, things happen. Agents went out, knocked on the doors of farmers all over America, and expanded the market for crop insurance dramatically. Along the way, Congress also improved the program. One of the main things they did was simply increase the level of support for farmers. They did that in 1994 with the Crop Insurance Reform Act. They did that in the year 2000 with the Agricultural Risk Protection Act. Both of those acts made crop insurance more affordable for farmers, and that huge increase in acreage enrolled in the program is largely attributable to the fact that it's a good program, but it's an affordable program. If crop insurance is going to maintain its position as the dominant part of the farm safety net, it has to serve American agriculture widely. Most farmers have to be able to participate in the program. That means that the portfolio, the products offered through crop insurance have to expand, get better, become more effective. A lot of that work has been done, but there's a lot more that still needs to be done. For example, since 2000, over 100 new products have been introduced into the crop insurance program and sold by by crop insurance agents and companies. The 2014 Farm Bill addresses this issue and mandates expansion in certain areas. One of the areas it suggests is what we call plans of insurance, the different type of insurance products that farmers can buy. The Farm Bill mandated a whole farm insurance plan where a farmer could insure everything grown on the farm, even if some of those commodities didn't have insurance products available to them. Livestock, crops, everything could be lumped together and insured under a whole farm policy. So improving the plans of insurance, improving the product offering is going to be very important for crop insurance in the future.